Okay, let's jump right into this explainer. Today, we're putting on our expert investment analyst hats and running regional grocer Ingles Markets through a rigorous valuation gauntlet. We're going to take the raw data and push it through some of the greatest frameworks in finance to see if this company is a hidden gem or just a value trap. To strip away all the market noise, we're going to systematically test this stock through 6 distinct sections. 1. Snapshot and the Buffett lens. 2. The Peter Lynch lens. 3. The Benjamin Graham lens. 4. Discounted cash flow valuation. 5. Alternative models. And finally, 6. Synthesis and verdict. Let's get to it. Section 1. Snapshot and the Buffett lens, the Oracle's test. We're going to kick off our analysis by looking at the company through the eyes of the ultimate value investor, Warren Buffett. Now, Buffett focuses on economic moats, consistent earnings, and top-tier management. To set the stage for us, Ingles Markets, trading under the ticker IMKTA, currently sits at exactly $89.03 per share, boasting a market cap of $1.69 billion. They operate a whole chain of supermarkets across the southeastern U.S. But what would the Oracle of Omaha actually think of that price tag? Well, let's run through his checklist. First up, the economic moat. Ingles actually possesses a really solid localized moat, thanks to its extensive real estate holdings and neighborhood shopping centers down in the southeast. Next, glancing at the balance sheet, their debt is highly manageable. We're talking about $511 million in long-term debt against a very healthy $361 million in cash and equivalents. That's a massive plus. But here's the catch. Their return on equity is sitting at a really low 6.41%. For Buffett, who almost always demands an ROE consistently above 15%, that is an immediate red flag. And then we have to evaluate Buffett's role for honest and competent management. Here, we just have to neutrally observe the ongoing proxy battle currently surrounding the company. Activist investor Summer Road is actively pushing for independent board representation, pointing to stagnant dividends, anemic growth, and a lack of transparency. On the flip side, Ingles management defends their track record, highlighting steady margins, debt reduction, and massive, ongoing hurricane recovery efforts. Now, Buffett loves a quiet, well-oiled machine. So this high-profile tug-of-war, it introduces a level of drama and uncertainty he typically avoids. Finally, Buffett relies heavily on approximate owner earnings. Basically, what cash is left over after you've maintained your assets. Looking at recent Q1 data, Ingles generated $38.4 million in operating cash flow, but they turned around and spent $36.4 million on capital expenditures, mostly for store remodels and hurricane rebuilds. That leaves extremely tight owner earnings. Because of this high capital intensity, coupled with that low ROE we talked about, Buffett would likely demand a massive margin of safety here. He'd probably sit on his hands and wait for a steep discount, maybe near $60 a share, before even considering a buy. Okay, Section 2, the Peter Lynch lens. Categorizing the grocer. Let's pivot and see how this looks using Peter Lynch's practical, growth-oriented framework. Now, you might initially look at a regional grocer and think, oh, that's just a slow grower. But Lynch, he would instantly categorize Ingles as an asset play. Why? Because on top of running supermarkets, they own massive amounts of incredibly valuable, unmonetized real estate across the Southeast. They literally own most of the shopping centers their stores anchor. The market is pricing in the grocery business but completely ignoring the hidden value of all that owned land. Now, what's really fascinating here is the tug-of-war in ownership. Peter Lynch absolutely loved seeing insider buying. And over the last 3 months, Ingles insiders have made net purchases of over $44,000 in company stock. They're buying, not selling. On the other hand, institutional ownership sits at 62.54%. Lynch usually preferred low institutional ownership, finding those hidden gems before Wall Street catches on. But this moderate level suggests the big players are already pretty well aware of what Ingles is holding. So, does it pass the test? Well, the PEG ratio, price to earnings to growth, is a sluggish 3.2, which makes sense since earnings growth has been declining over a multi-year period. But given that rock-solid balance sheet, the positive insider buying, and, crucially, that hidden real estate value acting as an anchor, Lynch would probably rate this a cautious buy to hold. It's basically a classic asset play just waiting for a catalyst. Moving right along. Section 3. The Benjamin Graham lens, the defensive investor. Benjamin Graham, the father of value investing, didn't care much for fancy stories. He cared about hard, cold numbers and finding an absolute floor of value to protect your downside. And guess what? Ingles easily survives Graham's defensive checklist. Market cap over $1 billion? Check. It's $1.69 billion. Positive net income and stable earnings? Check. Uninterrupted dividends? Check, currently paying out 66 cents annually. And the absolute best part for a Graham investor? A beautifully low price-to-book ratio of 1.05x. You are essentially buying the company right at the value of its net assets. Now for the really fun part, Graham's famous intrinsic value formula. We're trying to find a totally fair price for a stable company here. We take the trailing 12-month earnings per share of $5.49, multiply that by the book value per share of $87.50, and multiply all of that by Graham's base multiple of 22.5. Then we just take the square root of the whole shebang. And the math outputs a precise intrinsic value of $103.96. So what does this mean for us? It means Graham would look at today's $89 market price and see a built-in 14% margin of safety. For a strict defensive value investor looking for absolute asset protection, this math eagerly triggers a buy signal. All right, Section 4. Discounted cash flow valuation. Forecasting the future. We've looked at the past, we've looked at the balance sheet, now let's project the future using a DCF valuation. This is pretty much the modern gold standard for figuring out what a company is truly worth based on the cash it's actually going to generate. To build our base case DCF, we systematically run through 3 steps. First, we forecast the free cash flow for the next 5 years. Second, we estimate a terminal value. What's the company worth in perpetuity after those 5 years? And third, we discount all of that future cash back to today's dollars using a specific discount rate. Now, because the market is unpredictable, we have to ground our math in explicit assumptions. For our model, we're projecting out 5 years. We're applying a standard 8% weighted average cost of capital, or WACC, which acts as our required rate of return. And we're assuming a mature, very conservative 2% terminal growth rate. This aligns perfectly with a regional grocer operating in a mature, steady industry. I love a good sensitivity matrix because it brilliantly illustrates how tweaking our assumptions shifts the fair value. If we're feeling optimistic, say a 7% discount rate and 3% growth, the value shoots up to $130. If we're pessimistic, a 9% discount rate and 1% growth, it falls to $95. But our base case, sitting right smack in the middle at 8% WAC and 2% growth, lands at a fair value of $116.26. That shows some really significant upside from the current $89 trading price. Section 5. Alternative valuation models, multiples, and dividends. We want to make sure we haven't developed tunnel vision with our DCF, right? So let's run Ingles through some alternative valuation models. First up, relative valuation using price-to-earnings multiples. Ingles is trading at a steep discount right now. Its PE is 16.22x. Meanwhile, the retail and grocery sector average is up at 19.82x, and the broader market average is way up at 44.55x. If Ingles were to just trade up to its sector average, we get an implied comparable fair value of roughly $108 per share. Again, flashing signs of undervaluation. But wait, things get a little weird when we apply the dividend discount model. This model values a stock strictly based on the present value of its future dividend payments. If we take their 66-cent annual dividend, an 8% discount rate, and a 1% dividend growth rate, the model radically undervalues the stock at just $942. No way, right? Well, what this simply exposes is that management is hoarding their cash. They're reinvesting it back into real estate and capital expenditures, rather than returning it directly to shareholders through big dividends. And finally, Section 6, Synthesis and Final Verdict, Surviving the Gauntlet. After running the numbers through the absolute best frameworks in finance, it's time to pull it all together. Viewing all these fair value outputs side by side is incredibly revealing. The current price is $89.03. The Graham formula gives us $103.96. Our base CCF value is $116.26, and the comparable PE value sits at roughly $108.00. Literally every single mathematical model we ran suggests that Ingles Markets is currently undervalued by the market by a margin of roughly 15 to 30%. So what is the grand takeaway here? Well, you absolutely must weigh the very real risks. There's the uncertainty of the activist proxy fight and the millions required for the ongoing Hurricane Helene recovery efforts. But when you balance those risks against their pristine balance sheet and massive unmonetized real estate assets, the valuation gauntlet reveals the stock is a fundamental buy below $95. The math is clearly in your favor. But here is the multi-million-dollar question to leave you with. Are you patient enough to wait for this hidden real estate value to finally unlock? Or will you let the headline noise of a proxy fight scare you away from the classic Graham-style bargain?